following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger. Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is, of course, the portion of the show where Don and I grab some poor, unfortunate soul, usually a luminary from the options market, and force them to answer our questions. And today's unfortunate soul is indeed a luminary of the options market. Of course, we had him on. Of course, you heard him in the intro segment. He is Larry McMillan. He is of numerous accolades and fame within the option space. In fact, Larry, I think the last time you and I bumped into each other was down at the OIC in Savannah back in May, where you were receiving the Sullivan Award from the Options Industry Council, which is, of course, their equivalent of the Lifetime Achievement Award. So yet another award to add to your award-heavy shelf, I'm sure, over there at the McMillan HQ.
All right, thanks. Yeah, I don't know how award heavy it is, but I was certainly pleased to receive that award.
And of course, it is well deserved because, like for many guys like myself who came into the business in the mid '90s or so on the trading floor, there was kind of a you had two Bibles down there. You had McMillan and then you had Natenberg. Those are the two books everyone had in their back pocket when you first started off on the floor. Those are the books they handed you, and there was always a bit of, I guess you can call it, a dogmatic schism between those who leaned in the Natenberg camp and those who leaned in the McMillan camp. There are a few Hull guys floating around as well down there too, but it was always interesting to see who leaned one way or the other and which books they had. A lot of people had both, so it was you were definitely a heavy presence down on the SIBO floor. So that Lifetime Achievement Award is definitely well earned, sir. I think we had congratulations yet again on that.
Thank you.
And of course, many of our listeners also will know you from the Macmillan on Options and many of the other tomes you have there. And I think, like I said in the intro, I think a lot of our listeners will know you from those books and some of your earlier work, and will think of you very much in that general options education camp, when, quite frankly, if you look at what you've been doing for the last 4 or 5 years, it has a very strong volatility bent to it. Would you say that volatility and volatility education has definitely, taken the reins of your education a bit and shifted it in a new direction, where you're spending a lot of your time working with retail, actually explaining volatility as an asset class and the different ways to incorporate that into their trading? Is that the bulk of your time these days?
Well, yeah, definitely. I mean, as I said, we have a lot of different facets to the business, but yeah, everything is very volatility oriented. And, the introduction of listed volatility derivatives really has changed the landscape. I mean, prior to that, if you wanted to be long vol, you had to try to buy straddles or some obtuse thing like that. Whereas, here, you can actually trade the things directly, but there's still a lot of misconceptions, and there's a lot of people that don't seem to understand them, and so I would say it's not the simplest product in the world, potentially, especially since the VIX options don't, since they price off the futures, and most other people are not familiar with looking at options in that way.
How many times would you say you answer that question in a given week? Why aren't they queuing off the VIX cash?
Yeah. I mean, specifically, I mean, we don't get that specific question too much anymore, except if I go to, like you said, like you go to the Traders Expo, or you go to the Money Show or something like that and give a talk there, then you get that question a lot. But I hope to think we've educated our own customers and our own mailing list pretty well. Maybe not. Who knows?
That's true. You probably have a very select subset.
We're 32 years into options or whatever it is, and we still people don't understand what a put is. So maybe I'm being too optimistic.
Now, if you had to ask me the two most frequent questions we receive still to this day at the Options Insider, it'd be number one would be, of course, I bought a call and the market rallied. Why did I lose money? And then number two would be, why I'm looking at the VIX. The VIX is X number. I have these VIX calls. Why aren't they in tune? Why? And you have to, of course, explain the futures to them. So that's probably up there, their number two or number three question still to this day. It's just
right along with, hey, it's Thursday. Why are my VIX options not in my account anymore?
Yeah, there's definitely a lot of logistical questions to overcome when people first are coming to the VIX. But speaking of that, just in general terms, you obviously, like we said in the intro, you've been dealing with retail education for quite a long time, almost since the advent of listed options themselves. How crazy is it to you that in this day and age, in 2011, going into 2012, that you are actually spending a lot of your time these days educating even incoming basic retail options traders on something as intricate as volatility? Would you have ever imagined that, 20 odd years ago, that this would be where the education would move, and where a lot of the questions and the ground field work would actually have to would be in volatility and volatility trading for retail?
Right. I don't know what 20 years ago, but I have felt for quite a while that we did need listed volatility derivatives. And now that we have them, there's always going to be an education gap that has to be filled on anything like this. I mean, I remember when they listed puts in 1976. At the time, we had 250 stocks with calls, and they listed puts on like 20 stocks. And I was working at Thompson McKinnon at the time. I was the retail options strategist, and my boss said, well, they're going to have puts on every stock. And we all went, really? And I'm like, wow, that's an amazing concept. Well, now, of course, you wouldn't consider having a listed, stock with listed options always has puts and calls. Hopefully someday we'll get to the point where they'll have puts, calls, and a volatility derivative on everything that has listed derivatives. So we're a ways from that yet.
Well, sure. we may help make that a reality one day, Larry, because into the future we foresee not only having our realized volatility futures contracts on a wide array of underlying assets, but it would then be the next generation to go into a concept that we call vol shares, which would trade priced with no multiplier, just like a share of stock, and would actually reflect on settlement the realized volatility of the underlying shares. So it may not be for tomorrow, but it's definitely something that we've actually written about, applied for patents, and actually have in the pipeline.
Larry and Don, I think it'd be fun to have a show just with you, Don, Larry. Maybe we grab Alex Jacobson from the Options Express, and we can have an options reminiscence story where we can have a bunch of guys who have maybe a longer term perspective on the options business, and we could reminisce about some of those early days before there were puts and all of the other fun stuff. I'm sure the three of you could really tell some interesting tales about those days.
Well, I actually remember when I started at Morgan Stanley in the fall of '84, I was sitting right next to Steve Feinstein, who was the head options trader, and he had a very dear friend, a lady by the name of Irene, who was Larry's right-hand gal at Thompson McKinnon, and so we're going back almost 30 years, huh, Larry?
Oh, yeah, absolutely. I got on Steve a couple of years ago, but some high technical, like, wow, he's a rocket scientist in this business. I haven't seen Irene in a few years, though. Have you?
No, lost touch.
All right, and listeners, we had a spot of technical difficulties here, so we've switched Larry to the phone now, but other than that, we're happy to keep him on the show, and so we can keep having him answer your questions. And Larry, we were just discussing the comparative differences, if you will, between someone coming to you and saying, I would like to use, let's say, an upside VIX call as a hedge for my portfolio versus downside SPX put or even a downside SPX put spread. I know there's a lot of people who fall on one camp or the other in terms of what they prefer. What do you typically recommend over there at Option Strategist when someone comes to you looking for that type of, with that type of question?
Right. Well, basically, I view protection as a disaster protection. I'm not looking to hedge a 10% decline or something. And in that regard, I favor the VIX calls because VIX will explode much farther than the upside when you really need the protection. You know, say VIX is around 20 and you buy maybe the 30 calls as protection. If the market collapses, even if the market rallies for a while, but eventually collapses, VIX will go shooting through 30 and the protection will kick in for you. But if you buy SPX puts and the market rallies, then those puts get so far out of the money that they're no help on a market collapse, so you have to roll them up or spend more money for protection. So I'm definitely, in terms of ultimate protection, I think the VIX calls are better.
That's interesting. So you view of it more as I hate to use the cliche term, but a black swan type of protection where you're really looking to protect against the dramatic move as opposed to the more moderate fluctuations in the broad market.
Exactly.
And what do you do for near-term downside? You just let your portfolio run? Do you maybe do near-term put spreads, or what's the strategy there?
Yeah, what we do, I mean, the main strategy we're using in our managed accounts and things is we'll do a S&P or Spider put ratio spread. So we'll buy one strike, sell the next strike, and then even sell another strike below that. So we've got a naked option down there somewhere. If the market declines slightly, the put spread actually makes money down to the third lower strike, which is the short put. And then we buy VIX calls as a hedge against that event happening, that it could drop to that third strike. So in that regard, and we set these up for credit, so you can make money if the market goes up, make money if the market declines a little bit. If the market really gets creamed, then you're relying on your VIX calls to hedge off the disaster of like August or something like that.
All right, so you have more of a tiered approach then, where you would take the S&P products and the put spreads and whatnot to the downside for the near term, whereas the catastrophic event, you tend to lean heavier towards VIX for that sort of approach. Interesting.
Exactly.
It's really fun, Larry, to have these extra products floating around now because, you mentioned the 1x2 or the ratio spread, and those were always tricky to handle as an options trader because you obviously wanted movement to make the money on the first spread, before you got to the naked short option, and you were always rooting for movement, but then, whoa, not too much movement, not too fast, and go right over the hill. And so now you mentioned, there's a fourth piece to it, and that's that VIX call. Nice to have those things lying around these days.
Absolutely. I can see you've been in this trade before.
Right. Somehow I don't see you buying that VIX call, though, Don. Call me crazy.
Well, it's different times, and what's the saying? Different horses for different courses. Some of those markets that I traded had single-digit realized volatility. At the end of '94, we were looking at 7 and 8 on the S&P, and if you got 10 or 12 on implied, you were doing a great big deal. So we could afford to do spreads like that and hopefully not worry that the market was going to do anything too crazy. But now crazy seems to be the norm, and you've got to adjust your approach sometimes.
Yeah.
Speaking of adjusting that approach, I know, Larry, before we wrap up, I did notice quickly on your website there that you are offering webinars now for gamma scalping and to instruct retail in the fine art, or some may call it the black art, of gamma scalping. And of course, that was the tool we used to use back on the floor to make our long premium positions, to at least survive our long premium positions and on the off chance actually make some money with them. And it's often been one of the tools that's been missing from the retail trader's toolbox. So are you putting an increased emphasis on that going forward as a way to teach that missing implement to retail traders and allow them to trade more like an active professional options trader?
Yeah, well, I don't know if we have an increased emphasis on it, but the guy who's teaching that for us is Stan Freifeld. You guys might know him.
Yeah, I know Stan back from his OTA days, yes.
Mm-hmm. And so Stan is a great teacher, I think, and a very smart guy. So, he came up with the idea that maybe we should try to, discuss the topic, and it is very popular. A lot of people are definitely interested in it. I think once they realize how much work is involved, they may lose some interest.
That's true.
Not the easiest thing in the world to do.
Yeah, it requires definitely to be glued to your screens throughout the day, which is difficult for someone with a day job, as it were, to also be effectively scalping their gamma on a minute-by-minute or hour-by-hour basis.
Right. But, in general, our products, our webinars have been successful, and Stan teaches our mentoring, and, we've had a pretty good interest in that as well. But, in that regard, I think our main impetus still is in our newsletters and the recommendations we make to retail through our newsletters. So that's probably our number one best-selling product, really.
Well, since you mentioned your newsletters and your products, let's dive into that a little bit for our listeners and let them know exactly what they can find over there at optionstrategist.com, the different services and the different products that you offer over there.
Well, we have 3 newsletters. The flagship newsletter is in our 20th year publication, and that's the Option Strategist newsletter. It's got it comes out twice a month, and there's a weekly hotline update in between. But we cover the entire facet of option trading. We do some speculative buying, but we also concentrate very much on volatility trading, and including selling of high volatility premium, let's say puts on stocks that where we think that they're totally overpriced. Like, for example, Laura Larg in December, that sort of thing. And we also do a certain amount with volatility skewing, where we're looking for event-driven things, maybe earnings or maybe biotech situations or possibly even takeovers. So we set up volatility skew trades in those sorts of things. And then we do some actual VIX recommendations as well. But we sort of cover the gamut there. We have a daily version of that newsletter, too, for total option junkies. And then we have another newsletter which is strictly what we call it daily volume alerts, and it looks for heavy option volume in a particular situation where we're just looking probably to just go long options, trying to follow along with smart money if we can identify where the smart money is actually working.
That elusive smart money.
Right.
You often find at the Options Insider, at least, that size money and the smart money are not always synonymous. And
no.
You see some interesting trades going up for quite a bit of size that are not exactly what we would call savvy, at least in the options spectrum.
Right. So we're looking more for just, straight out buyers of things, and, like you're saying, whoa, what's going on there? And then, the next day something happens and you go, oh, that's what was going on there.
All right, thank you for that, Larry.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.